First thing I have to say before I just go into it, I am no expert on stock marketing or stock market or trading. I'm just sharing my experience and my journey through this whole thing. Whatever I have learned, I would just try to share my knowledge. I'm primarily a scientist, not stock market or expert. So this is just my personal experience that I just started. So my journey started in 2004 or 5 time frame when I was still in my grad school, and I'm going to just save the story for later if the question is asked about it. But just to having said that, uh, stock investment is not an easy thing to work. It is There's a lot of risk, and all the time when you're just investing your real hard-earned money, there's always a risk that you lose it. So I think I just take it as a love-hate relationship. So, and I just look at it as a cycle that goes on, and sometimes it works, sometimes it does not. So what happened is that, uh, somebody just encourages you that, hey, you know what, you can make a lot of money in the stock market. You invest some money in there, I mean, based on your capacity and your ability to take the risk, and you make some money out of that. And what happens is that, suddenly greed takes over, and you then start pouring in more money in there. And when you're not ready for that, or you just do it like prematurely, what happens is that you get a loss. And you get, sometimes people lose a lot of money in that cycle. And you say that, okay, you know what, I am not going to do this thing ever again. This is not my cup of tea. So you just, and then you meet yet another friend of yours, and she says that, you know what, it's not so hard. I can tell you that, there's so many things that you can just do with it, and you can just manage your risk, and you can just maximize your gain, and blah blah blah. And then you go in there again, and the cycle goes on. So it's not something that it's not something that but once you just go in this cycle, you just keep going in there, and one at some point you become an expert, and then you start like skipping from all these greed loss, and then just you start stabilizing yourself. So my objective here in this talk is to try to share my knowledge and explain you that how you can avoid this whole cycle, and then get so getting started. So it's typically, if you Google, getting started is like just simply opening your account with one of the brokerage provider, and then put some seed money in there and start trading. But I would say, no, don't do that. Don't do that. That's like the typical I would say framing mechanism they just put on, and you get in there. So I would strongly recommend educate yourself. And the longer you educate yourself, the better you understand things, the higher chances are that you will survive the whole thing. I'm actually dividing this into like 4 sections. So just we'll just try to see if we can just divide this thing in equal timing, but let's see how we go about it. Okay, the first thing, opening your brokerage account. I mean, of course, the question comes that, where do I open the account? So I tried my best not to answer those questions which are like can easily be Googled. But you know what I toward the end I realized that everything that you want to know about this whole stock market and trading, pretty much everything is there in the Google. So you can just go Google it, and Google is going to bring you like all kinds of information there. It's like if you're a good reader. But if you're like lazy reader like myself, you tend to listen into the videos or tutorials. That is not something that's like available, like a shortage. You can just find tons and tons of videos, tutorials, and so suit yourself. Pick one of those brokerage accounts, open them, and I would say that do not just jump in there. Just put some reasonable amount of money that you can think that if it is lost, I would just consider this one as my uh, experiment money, and it's fine. I will be able uh, to sustain that loss. So there are like typically three kinds of accounts you can open. Regular cash account, that means that you will put your money in there, and that once it is transferred into your brokerage account, it will be available to you for immediate transactions trading. Margin account is like a little bit more risky account where it actually allows you to trade more than cash that you actually own, and that is like, is a little bit risky. So there are implications. I would say if you're going for that, do study it. What all are the possible pitfalls in there? Don't just jump into it. So if you're a beginner, I would strongly recommend start with a cash account. And then the riskiest one that I tend to play with more often is the option account. So on this slide, anything that is there is like also available on the link below that I shared. So nothing secret that I'm sharing here. So next is to get yourself done. So like you have to have an investment strategy. The thing is that you have to make sure that you know that what you're trying to do here. You want to set it up as your regular income or supplement your income, or you have some spare money lying around that you would like to grow. So that is like one that you have to just be clear in your objective, because sometimes when we just keep going in there, those lines between those your objectives start becoming blurry, and you tend to just start, when you read reviews, or you talk to people, or you just go on some WhatsApp channels and then listen people doing some funny kind of transactions, and you just tend to just lose track of what you originally wanted to do with your investment. Then comes the long-term versus short-term investments. Long-term investment can go from anywhere from like few months to few years. That means that you pick up some security or some ETFs that you think that, okay, you know what, I'm going to dump my money in there. I'm going to go to sleep for 6 months, or you will just like once in a while you'll just check the stock, or you read the news. Hey, the stock market is going really low. You just stick your money in there, and then you just wait or just go to sleep. Don't worry that if the markets start tanking further, don't worry. It's going to, the market always takes correction, always go back. So if you find times like this, jump in, invest it, and then just forget it. So that's a long-term investment. It's like least painful in a way that you don't see it every day. But this is like a human instinct. Once you just put your money in there, you just start looking at the stock news and stock performance every day, which is like a very bad overall for your health and for overall your life, because then it starts becoming a part of your life. Compared to that, if you're like you doing it like a more often short-term investments, the short-term investments can go from few days to few weeks or max a month or so. So that's a short-term investment. And there's a more like I would say more advanced version of stock investment trading is called day trading, where you actually just trade in like you just buy things in the morning, and just in a couple of hours you sell it again, you buy it again, you sell it again, and you just keep buying, selling all day long. sitting in front of a computer, watching the stocks going up, going down, going up, going down. That is like, it's like I would say like, don't go there. It's a very common human tendency that, once we invest in the market, we just keep seeing the stock over and over and over again, and it's just like, and every time it's like going like a few cents down, few cents up, and you just start like getting your blood burning. So don't do that. The next thing is the transaction type. So typical stock market trading is you buy stocks and then you sell them. That's like, so that means that you can only make money when the market is going low to high. Whereas you must have heard a lot of time from people saying that, hey, you know what, you can actually make money when the market is going down. And that is where the concept of short or sell means that you can just sell or short. And how that works is that you can actually sell before you even buy. So that means that the first case is very simple. You just buy cheaper, and when it becomes more expensive, you sell it. So low price, you buy at low price, you sell it high price. Whereas when the market is going down, what you can do is that you can actually sell it. And when you want to sell it, what happens is that the first step, you actually borrow it from your broker, and broker actually lets you borrow that, and then you immediately sell that in the market. So that means your account, say suppose that you just shorted say Apple stocks, like 1,000 stocks, say, you would borrow it from your broker. They would let you do that, and you will immediately sell it in the market. And what happens is that your account would show negative 1,000 stocks, or say maybe 100. So negative 100 stocks. So that means that you would not be able to realize the gain or profit out of that until you settle down by buying those stocks back, and then that will just complete this transaction, and that's how you would be able to make money. So now, having said that, since we are going through bearish market these days, we can do this try of this short. That means that you can just short sell something that you anticipate that it's going to go down, and you can later buy it back at a lower price and then settle the transaction, and that's how you make the money. Okay, so next thing is the investment evaluation and thought process. So that means that what should be the underlying thought process that when you're planning to pick where you would like to invest. So I strongly suggest that do not just follow your friends, or someone told you that, hey, just buy it, that's wonderful something. That's like a very common pitfall, that when you just see that some people are saying that buy this one, buy that one, do understand what it is. What are you trying to do? So pick companies, not stock. That means just go read the summary statistics of their portfolio. What is their typical 52 weeks range, and what is their profit earning ratios, and create a list of your favorite stock. That is absolutely important, because you should not just like go on, because there are about like 200 about 3,000 active stocks, and they're like, if you just look into the full list of the tickers out there in the New York Stock Exchange, there are about 6,000. So you do not want to just go and fish around in every one of those. You should make sure that you know where you're investing. So there are some companies which are like multi-billion dollar market cap companies. They're very stable. You can just, and their stock is very expensive. And it's very difficult to actually make money out of those. So a typical tendency is that, you just go for the cheaper stocks. When you just go for the cheaper stock, so now you have to understand that now you're putting your money at risk by just going for a company that can collapse completely, and then your money can be gone. Um, and one thing is very, very important, that you should not put all your money into one type of stock. You should just diversify it. There are like different segments of the industry that you can just invest at. But before you go there, I again just cannot just emphasize more on that you have to understand the underlying business and the industry segment where you want to invest. So that's the list on the left. I would say that's more of a static one-time deal. That means that when you're just going through your basic process, just get yourself a lineup. Okay, you know what? I like these stocks. These stocks are good, and you have to document your reasoning that why you are just picking them up. Once you have done that, then there's something that is like your more, like I would say, day-to-day behavior or dynamic behavior. And your dynamic behavior should be check your emotions. The moment you're about to do the buying or selling, just make sure that what you're doing, plan ahead for panicky times like these that you're seeing these days. But remember this thing: market always corrects itself and comes back. So no ebb or flow is forever. There's always cycles. And build up your stock positions with a minimum of risk. I would just say that try not to go for risky stocks. Try not to take some risky positions, because you know that when you take risky positions, yes, you do have a chance to get more profit, but there's a higher chance that you lose everything. One more thing that I have to just mention at this point, that you have to keep in mind that what you are pitching yourself against. There are multi-billion-dollar companies out there who are just doing all this stock trading electronically, and they are doing it on rule basis, and they're like artificial intelligence is going on. They're just doing all sort of analysis electronically, and you guys are like doing it all manually. So I would just say that make sure that you understand what you're pitching yourself against. Yes, the last one is very important. Overactivity. No, don't do that. So this is like strictly, I would say, or mostly be avoidable. Okay, so let's look into a quick guided tour how to actually look for some stock. So money. So I'm just like, there are tons of, like, if you Google around, you'll just see that a lot of stock evaluation and performance tools out there, and comparison tools out there. So what I'm going to do is I'm going to pick up one of these, and then we're going to go to Yahoo Finance, and then we can just pick one of these. So typically the stocks work with their tickers. I think that much you probably know already. So if I just pick this one, Apple, this will give us, so now you can just look at these numbers, and you can just look at the market capitalization. What is their profit earning ratio, and their 52. So these are the numbers that you're looking at. So compared to that, if you just look for some other company, so like GE, look at that. So this one is much smaller company compared to the Apple. So now immediately the point comes in your mind that, what if I want to compare these two? So side by side. So there are some tools here that you can compare things side by side. So you can just simply say, you know, AAPL. If this actually lets me do that, or here, AAPL, and then you say GE, compare symbol. So now you can see that how this thing is like telling you that where it is opening, where it is closing. So if you look at this thing, this stock is, Apple is like way too expensive. And you remember this thing, that your profit, it's like going to be measured in percentage. So if you look at this thing, what is the high to low ratio here? And what is the high to low ratio here? So those ratios are going to be determining your profit range as well. Overall, you can just compare these stats here. If you go further down, there are some more. You see that market cap? These are the number that actually tells you how stable is your investment, how stable is the company where you're just investing. So going back, there are other things that other tools out there like Market Beat. This is another one. I'm pretty sure that this is yet another one. It's very easy. They tried to just grab your email, but you can probably use a different browser to just go without it. So, okay. So I would stop here and then just see if we have any quick question that I can take, because this is the first segment ending. So if something is like Ali, if you have anything related to this segment, quickly we can just take care of it.
Sure. Thank you very much, Dr. Rashed. So we do have about 3-4 questions here. I'll let you decide which ones we should answer right now. Which ones?
Yeah, you can just go ahead and let's try to catch one of them.
Sure. So the first question we have is by Nasir Zahidi. It says, could you please provide an example for short? And the question that they're asking is, let's say you buy 100 stocks for $10 each, and then you borrow 100 stocks for $10 each, and then you buy back the same 100 stocks for $8. So in that example, did you actually make $200? That's the confirmation that they're looking for. If you could perhaps play out an example for shorting.
I mean, there's absolutely no doubt about it. It's just like you know that you can just think about it that it is literally opposite of like buying before selling. That means you buy cheap and then you sell more expensive. You buy low, you sell high. Where in the short, the process is that you actually sell high before you actually go back and buy it cheaper. So that means when you're actually shorting any stock, you are actually saying that you're like betting that the stock is going to go down. I see another question here. That's what range of PE ratio would you say makes stock attractive to buy? Okay, so the smaller the PE ratio, the better it is. So you saw that, and the higher the PE ratio goes, that actually tells that the market is like the stock is artificially inflated. So I can just give you a quick example of something. Let me just see if I can just get you some example here. Look at this one. Oh, this PE ratio is not available. That's not good. So let's see if we can get the PE ratio from profit margin. Profit is, I think there is something like, this one, very strange that the PE ratio for GE was not there, because it's a pretty big company that we should not have any trouble with that. So let's see, Tesla. Everybody's excited about Tesla these days. So okay, there you go. Okay, so when you go to Tesla, Okay, that's very strange. So it seems like, there's something going on. There's no PE ratio again here. Let me just see here if the PE ratio is available somewhere here on these ones. Sometime the PE ratios are like available. This should be here, or if you go into stats, sometime they're also there. There you go. This is not available throughout for Tesla. So if the company does not actually just publish its profit earning ratio, so this one, another one, so you can just look into this, the forward one. See that this one is like telling you that how much is the ratio between the profit and actual earnings. So let's see if we can, this is Tesla. Look at this one. This is absolutely criminal. This is telling you that this stock is like not worth how much it is being sold for. So this number is telling
Dr. Rashed, we can't actually see your screen. I don't know if you need to share it.
Oh, I'm sorry about that. Somehow we lost it at some point. I thought I was sharing my screen. So if that happens, please just let me know immediately. Okay, so I am now, okay, here it is. I am just showing you two different stocks here. See I see that some of these PE ratios are not available because of the stock market is like unstable, but look at this one. So these low numbers of PE ratio is telling you that, this is like the market value of the stock is compared to what its actual value is. When the ratio goes really, really high, look at this one, this 384 for Tesla, which clearly tells you that the stock does not worth. The worth of the stock is not as much as it's being sold for. So this is an example here. Let me see if I can take one more question.
Dr. Rashed, if in the interest of time, if you want, we could just take the remaining questions at the end.
Yes, before I just go on, I just wanted to make sure that we are like comfortable with this section. Okay, so next thing is the common stock indicator. So this is now real, I would say, little dry stuff comes up. One thing that you have to understand that when it comes to the stock, they're like, you cannot do much about it. And if you're just watching, typically this OHLCV, these are the 5 parameters that are published and recorded, and you can just pretty much find the history of every one of those. And these are the one, so open, high, low, close, and volume. So that means I'm going to just elaborate on this thing. So open means that at the price at which the stock opens in the morning, and during the day, it just goes high or low. And there's a highest point it goes, and there's a lowest point it goes during the day, and then it closes at some point. And after that, there's a last one is the volume. These little bars underneath that are telling you that how much stocks have been sold or bought. The one thing in the stock market transaction is that you cannot surely say that if the stock is being bought or sold, because every time you buy it, somebody must have sold it. So every transaction is like buy or sell. So how do we actually tell that if the stock is being sold or bought? So what they do is that if the stock is being bought at a higher price than its previous period, that means it's being bought. And if it is sold on the lower price than its previous period, so when I'm just deliberately carefully saying period, because if these intervals are like on the day boundaries, that will be different. If you just like go, you can just go as like as down to like a minute boundaries. That means that during the last 1 minute, it was being sold higher, and then now it is going down. So for the day traders, they just see these candlestick plots on like minute boundaries or 5 minute boundaries. So that is like totally crazy for like high speed or high frequency trading. But for common Joes like us, this is a typical candlestick plot that just tells you that what is the body of the candle is telling you the swing during a given day that stock had, and the volume bar is telling you that how many stocks are actually been like. So when the candle is red, typically the stock traders call it that people are dumping the stock. When the body is black, that means that people are buying the stock. The stock is being bought. So as I just showed you earlier, there are like some, I would say, these are typically lagging indicators. They're not, none of them are actually truly leading indicator, the trend, momentum, volume, and volatility. So in this context, another very commonly used momentum indicator is called the moving average convergence divergence, is MACD. I know that most of you, I mean, expert folks might already know about it, but I'm going to just try to explain you this thing with a very simple example. That suppose that you are not making profit every day, every month, same. Like sometime you're making say $10,000. Next month you're just making say $15,000, and some months you're just doing $8,000. And you know that the things are like going up and down for you. So if you just look at that erratic curve, nobody can clearly say that, you know, if you have been making good progress. So a very simple thing is that if I just ask you that, okay, you know what, if I average your earning over the 12 month, that is say $40,000 per month. And if I average your last 3 months profits, and they are say $50,000. So quick questions. I would just look at the chat and then say that what people are saying. You're doing better or you're doing worse. Your 1 year average is 40,000. Your last 3 months average is 50,000. You're doing better or worse? So I do not get, okay, so you're definitely doing better, good. Okay, somebody said worse. No, it's better because you know that the average actually smooths out the curve. And if you, that tells you that, you know, in the last 3 months, you did something that actually just makes your last 3 months average better than your 12 months average. So that is exactly what MACD is doing, except for it is just doing a little bit more tricky thing, is that instead of using a simple moving average, it just used an exponential moving average, which gives a little bit more emphasis to the most recent transactions, or compared to the like all of them. So that means that most recent numbers are going to be given a little bit of emphasis compared to the older one. And now let me just explain to you this curve a little bit. This one, if you look at, there are like two red, one is red line and the other is the black line. The red line is 26 days average, 26 period, I would say. 26 past 26 period average. And then the black line is your 12 days average, or 12 periods average. So now you can very easily see that when the black line is above the red line, it is telling you that most recently you're doing better than like longer term. That means every time, so that means that when you see the black line crossing the red line from low to high, like, you know, when the black line is crossing from lower to above, I would say like cross it upward, you can see that the red, which is a with the blue, which is like a 9 days smooth curve, that tells you that now the pricing is going up. During that time, you see that every day the price is getting better. The moment you see that the black line is crossing the red line from top to bottom, that means that up to down, that crossover is called the when the stock starts going down. So there's a and that is called divergence. So convergence, like when it is like both of them are like converging, and diverging means that when they are just going away. But in both cases, when they are getting close to, so usually if you look these graphs, you would see that when these convergence events happen, that is the point. Typically the stock actually starts changing its trend or changing its momentum from like going down to up or up to down. So I can give you some, I will just go ahead and toward the end, I will just show you an example that how MACD is a very simple indicator that now your stock is going to go up for a few days, and then before it converges again, and then it's going to go. So typical stocks have like these cycles, and you can just see that, you know, they're like going convergence cycle, divergence cycle, then keep going like this thing, and you can just look into this curve, and most of the people just feel like very comfortable just making a lot of decisions based on MACD. Okay, the next one in RSI. So before I would just keep repeating this thing so that you just get this thing very clear that none of these are actually leading indicators. That means that no matter what, these are all lagging indicators. That means that what already happened, it is based on that. It's not telling you what is going to happen, because you can just do speculations, but you cannot be sure. The next one is that it's yet another momentum indicator, and this is called the relative strength index and the money flow index. So relative, this RSI is very popular. It has been around since 1978, and a typical point that you would have to look at it is that when a stock is oversold or if it is overbought. So if it is below 30, that means it is oversold. That means it is time to take a rebound. It's going to start going up. And if it reaches all the way to like 70%, that means it's oversold, it's going to go down. So if you look at like a typical stock cycle, you will just see that this will be very obvious to you that this RSI indicates the going down and up when the trend is changing. And on the money flow is yet very similar to RSI. It's just like instead of relative strength, you just say that, okay, it also incorporate the volume of the work. So RSI does not keep the volume in the equation, whereas the MFI actually put the volume in the equation. That actually just makes it more robust indicator. But I usually plot them both to see that how they are doing compared to each other. A lot of time I have been like, people ask me, what is the Bollinger Band? Bollinger Band is built with very simple, with simple moving averages, and it actually just provides like a sort of a guard band and tells you that it's a typical volatility indicator, and it tells it. Um, Let me just see. Somebody asked a question. Okay, yeah. So the question was that the question is that is the RSI the crossover of RSI or MFI means anything? No. I usually don't look at the crossovers. I usually just see them crossing these typical 70% and 30% lines. Since they are like the underlying calculations are very simple, similar, that means that, as I said, that RSI is like just looks at the price, how the price is going in each period compared to that MFI actually keeps the flow as well. So yep, no, I mean, I do not take the crossover. I don't see the crossover has any impact here. Yeah. Okay, so let me just go on to this Bollinger. So we were talking about this Bollinger Band. Bollinger actually just creates two or three simple moving averages. And based on those moving averages, it actually provides you what all are the high or the low side of the possible thing. And it just gives you a volatility index. So when Bollinger Band is very wide, that means that your stock has a tendency to just fluctuate too much. Could be going down or could be going up. So there's like a more details. I think the scope of this call would probably not be going deep into the Bollinger, but if you just Google it, you'll get a lot of information about it. And I would be happy to answer if you have any. So one of these indicators are called alligator. And I don't know if anyone of you have already just came across it. It's very interesting. Bill Williams invented this thing, and what they do is that it is like a very simple. They just take 13 period, 8 period, and 5 periods moving averages, and then what they do is that they actually just shift the 13 period, 13 SMA, the simple moving average of 13 by 8 periods, and the simple moving average of 8 by 5, and then the 5 by 3. So they define it like this. They say that the blue line is the jaw of the alligator. The green line are the teeth of alligator, and the purple line is the lips of the alligator. When the jaw, the teeth, and the lips are closed or intertwined, like you can just see here, the alligator is sleeping. So, or it's going to sleep. And the longer that you can see that here, the alligator has been sleeping for a long time, and the longer it sleeps, the hungrier it becomes. And there's like highly likely that it's going to start waking up. And once it starts waking up, it's when you see that it starts opening its jaw, and then see that it's like picking up lips, and then it starts eating something, and just the whole mouth is open. So you can just see that how this mouth is open, and then start feeding itself. And as it goes on feeding, it starts like losing interest to the food. That means the price. And then it starts like closing again. And then this is like another interpretation of like a simple moving average. It's a I would say it's a simple version of the MACD. Some people actually like this one. And there's a trick here that they try to convert this thing from lagging to a leading indicator by shifting the simple moving averages here. Okay, so Before I go there, I would just like to just show you that how can you uh, look at or just draw these curves yourself here. If you go to the charts, and this is probably not the best, I would just say which will be the best one indicator. So maybe the Facebook could be the, it's comparatively. So there you go. If you go to charts here, so in this chart, you can, I have already done this Bollinger, so I would just say, if I just say Bollinger Band, if I just turn this one off, maybe I can just, so if I close this one, how do I get to the, from line to candlestick? So from here, you can just go from line to candlestick. And if you want to add some more indicators, say RSI, and you will just start seeing the RSI curves down here, and you can see that it's also bringing the MACD here on the bottom. And there's a, now if I just add the Bollinger bands here, maybe, you know what, I think I will just add the alligator, because that's interesting one. So here's the alligator is now, see that this is alligator, and you see that alligator's mouth is closed, and then it's like about to open. But if the lip goes down, that means it's going to go down further. I'm going to go ahead and add the Bollinger's band here as well. Every one of these indicators that you're seeing that you can add here, they have explanation. You can just Google it, go look at the Investopedia. You will be able to see all of these. Let me just see if I just go, there's a way to go full screen. Here it is. So you can just zoom it in and then just analyze these curves. You have the full history of this thing, and that is awesome. Okay, so I'm going to just, I'm sorry, did I stop sharing again? I'm going to go back, share. And before we go to the next topic, I would just strongly recommend that whatever you do in your stock buying, selling, you always record that why did you buy something, what was the RSI, what was the MACD, I mean, did it break any Bollinger Band, what was the state when you actually bought or sold some stocks. Okay, so having said that, I would just now go ahead and then enter in the last topic of our talk, that is like option trading. So option trading, there are like some, let me just see if it seems like somebody's asking a question here. Okay, so the question is that MACD stock trend will change at each convergence. So buy and sell decisions are convergence. So yes, I mean, I would say like the buy and sell decisions are not exactly, so the convergence is usually the initiate, like usually if you look at the, let me just go back to this chart, and that would be easier to show you here. So usually what happens is that when I see this black line going above the red line, that is the time that I know that this stock is going to go up for a few days. And it could be false as well. Look at this thing, it's not like it always happened, but most of the time it happens that when the black line crosses the red line from low to high, that means that this stock is like already gained a positive momentum. That means it's going to go up, and I usually buy the stock at this point, right after it converges upward. Sometime, and then selling is not on the convergence. Just to remember this thing, because once it just again start converging, it means it's already gone down. So somewhere in the middle, when this thing, it keeps opening, and you just try to see that, okay, where it is like peaking. If you're doing the short sales, this is a very good example. You will just start shorting right at this point when the black line is crossing the red, and then you will just keep it sometime where you just see that, okay, when the trend is start going backward, somewhere in the middle is and that is like based on your greed or your target. I mean, if you have set your target well, you would probably not wait for another convergence. So convergence is always a point where you actually start your transaction, but you complete your transaction somewhere in the middle of this two convergences. That is how the MACD is used. So let's go back to stock options. Okay, let's see. Okay, I think let's look into this then. What is stock option? So there are many types of stock options. I would just talk about call and put for this call. I mean, there are more. You can just educate yourself about them. This is a typical like a definition of, so I'm not going to read it for you. So I'm going to give you this example here. So what happened? This is a Wrangler's view of call option. So Jack bought a batch of 100 horses for $7,000. So I would say like hold your questions for now, and just focus on this thing, because this thing is like very like is a hard thing, not easy, because option trading is like a very difficult topic. So I would just require all of you guys focus here and listen to this one. So there, I'm giving you an example. Jack bought a batch of 100 horses for $7,000 each. So you're just talking about $700,000 of horses. Now, Jack wants to sell this batch as a like a, you know, since he bought a batch, he sells a batch 100 horses. So this is a default size of a contract size. So typically when you're just buying a call option, it means that the underlying, if you're buying one contract, you're actually talking about 100 stocks. Now, what happens is that Rox is another guy, makes a contract with Jack that if we let him have a batch of horses till the end of March, that means March has just started, that means for a month. So that is the end of March is the expiration date of the contract. He will be able to pay Jack $8,000 per horse. But at this point, he is not like, you know, right now he's not buying the horses from Jack. Rox is smart. He does not have $700,000. But he is like making an offer that he can pay $8,000 per horse to Jack if he let him have these horses for a month. For that, Jack tells to Rox that look, you have to pay for it. So what happened is that the contract is that Rox will pay Jack $20,000 premium. That means that for this $20,000, Rox can have these horses for a month, and during this time, Jack cannot sell them. And now what happens is that during this time, Rox goes in the market and could sell the batch for $10,000 per horse, making $2,000 per horse. Yeah, you know what? I misspelled it. It's not horse, it's hours. Not hours, horse. So what happens is there that you can very easily see that Jack has made $200,000 profit by investing only how much? $20,000. So that means the profit, because he has already given that $20,000 to Jack. So his actual gain is $180,000. And whereas Jack, who actually bought each horse for $7,000, he actually just made $100,000 as well, plus this $20,000 that was given to him as a premium. I would like to stop here to just ask every one of you some if to let you ask question here, because I think we are like out of time. Before I go to uh, and then show you that how the stock options and are seen, if you can actually buy it, and I will just spend some time to just show you the visualizations that I usually plot to actually look into the data I see for stock options. There's a version of the stock option that is called put, which is exactly opposite of this call. Whereas where you so call option is I would just say that it's a right to buy. Right to buy. That means that your contract is saying that you have a right to buy these horses at $8,000 per horse in the next 1 month, whether you buy it or not. It's up to you. So there could be a possibility that Rox might have not been able to find a good buyer, and this contract might have expired. Then once the contract is expired, this $20,000 is gone to Jack, and Rox would have not made any money. That means he must have lost this $20,000. That's it, and no gain. Put options are exactly opposite. They are, compared to this one, they are right to sell. That means that you just tell somebody that, okay, you know what, if I would just have a right to sell you something, and I can just sell it anytime during the next 1 month. So, and you cannot refuse. That means that somebody will promise that, no matter what, I'm going to buy things from you at this price. And that price, underlying price, is called the strike price. So that is how the stock options work. And you can just see that compared to like simple stock investment, stock options are like way more lucrative, because you can just see that how Rox just invested $20,000 and made $180,000 out of that. And this is like, if you're smart and you know how stock options work, you can just invest, say, like $200 or $300 and then make thousands of dollars out of that. So this is the one area that is like very risky, but you can just maximize your gain if you understand it, how it works. So I'm going to just quickly show you that how the stock options are when you look into the actual world. So I would just go for Tesla. Maybe Apple will be a good idea. If I just go to Apple and then look into this, I'm sorry, this one. You go to options. You can just see here that on the top left here, these are the expiration dates. That means that you can buy something for expiration date out of these expiration dates. And I would just pick, say, May 15th. If we just say that, okay, May 15th, and what is right now the price is $273. If I say that by May 15th, this is going to go up. So right now, I'm going to buy it for $20, $20.50. And this is, remember this thing, this is the price for a single stock. The contract is going to be for 100 stock. That means you would be investing $2,000 for one contract of this one. So that means for $20, you will, for this one, this is your premium that you will be paying. This will be the strike price. That means the $270. So what you're technically saying, that if you just pay $2,000 now, from any time from now till May 15th, you can lock your price of these 100 stocks of 200 at $270. Now, from now to May 15th, if the stock goes, say like it goes back to $300 straight, right? So you're talking about what? 30 times 100, $3,000. So that means you're going to be making $3,000 straight out of this thing. So that means that this $20,000 to $2,000 investment that you're going to do, you can just make $1,000 on that immediately. So that this is like 30% gain. You can very easily see here. Okay, I'm going to now, just having said this thing, one thing is that there's no historical data for options. And there's a lot of data that you have to see that, there are like tons of strike prices. There are like the premiums. How we just look at and then say that, okay, what it is telling us. And this stock options are literally, people are betting that how the stock is going to go. So that means if I buy this one, I invest this $2,000 right now, I'm saying that, by May 15th, I guess that this is going to go beyond this one. So that means it is going to, if I just put the strike price to this, the premium price to this one, so that means that I'm betting that it's going to go above $290.50. So that is my break-even point. That means that if the stock goes at 290 and 50 cents, that will be my break even. I would not make any money at that point. But if it goes above that, you will start making money. So the guys who actually bought this one today, or like whatever on Friday, they were betting that by this date, this is going to go above that. So what I did in this area, that I started plotting these. So Ali, just let me know that if I have to just stop here or start taking questions, or should I just go on for another 5 minutes to just show the stocks that I plot usually? Okay, so this was done on February 24th. This is like definitely old one, but I can just still show you that what this means here. So what I plot, this is my typical plot for this thing. When I do that, I just put those expiration dates on down here, and I pick the top 7 high volume options, and start putting their premium down here. That means that how much they cost each, and based on that, what is their projected price. So that means that how many people are betting. So if I just look at this one, so on 24th, when I plotted this thing, let's look into this one. So on 24th, it was about 6 o'clock. So I think we'll probably should look in on the next day, 25th. So on 25th, these are the put options. These are the call options. So the put options, this is telling you that about, say, 27,000 or 28,000 people were betting that the stock is going to go below $293 before February 28th. So now if I just go back and look at the data of itself, the Apple, and we can just see that what was the situation back then. That will tell you exactly that what was the price on 28. So 28, 26, maybe, you know what, I should just zoom it in a little bit. 28, 25th, 27, 25th here. 25th, if you look at the pricing down here, so the low has been 286. If you look on the top left here, 25th here. So on the top left, you can see that the lowest that this stock fell was 288. So what I'm trying to say is that the people who are betting that this is going to go below 293, they must have made like at least $10 for each stock for this one, because they were betting it that's going to go down. Compared to these guys who are like too much optimistic, they must have lost. So this is how I just look into these stock charts. I recently started plotting these tug of war plots. They're more complex, but I will just keep them for some later sessions. I'm going to stop here and I will just start taking questions. Okay, so Ali, you can just you can pick, or at this point I would say, like, even if someone would like to just speak into the mic and unmute yourself and then ask the question. Please do introduce yourself though, your name.
Okay, this is Ali. I'll just read out a couple questions from the list, and since we are towards the end of our time as well, I see there are a lot of questions, but what we can do is we can, Dr. Rashed, if it's okay with you, we can just start with a couple questions, and the remaining, we'll share with you in the form of a text document, and you can just respond to those, and we'll publish those if that works.
So the quick question that I can answer, can you share the presentation? Yes, I actually made this presentation for you guys, and I definitely will share it, and Ali will be able to tell you that where and when you can just look at it. Ali, you can just shoot your first question.
Okay, so there seems to be one, and this is a quick one as well. And this is talking about the charts and indicators. And the question is, are these indicators available free of cost, or does it carry a cost in the brokers? Dr. Rashed, you're on mute.
I'm sorry about that. That's what happens. So I was talking on mute. I'm sorry. Yes, so I showed you that all these indicators you can just actually look at on this Yahoo Finance. So if you want to do this like a visual inspection, so you can just go here and add the indicator, and Yahoo Finance is practically free. You can just always just look at these things, add as many indicators that you want to add. You can just see that there are RSI. There's another, my favorite is like, it's called stock chart. So I have the link here. So these are the stock chart. They also just bring in up here. You can do some sort of analysis here. They're generally free as well. Most of the data sets are available for you to actually download, and those are enthusiasts like data science people or just want to play around with data. There's a historical data that you can go and download from here, and then it will just download it as an Excel file. You can just always play around in Excel sheet, or like if you're like some other R or Python or some other studios that you use to play with your data, you can always just play with this downloaded data. But remember, this is limited to those 5 things: open, high, low, close, and the volume. So you get the volume. So this is adjusted close, is that, sometime what happens is that the market closes at some point, but some transactions, like towards very end, they were still in the middle. Once they are settled down, usually adjusted close and the close is like almost the same. But sometime when the market is like too much in flux, they're a little bit different. But these are the data that are available for you to do offline or analysis, generally free. Only data that is not available is the historical option data, because option data is like once you go to option data, I think option data, you can also download the option data as well, but that is like only available for that particular day. That means that you have no idea that what was the volume, what was the price, what was the different things that are happening with the stock with options in the previous day. Uh, so if you want, you can always just start recording and dumping it and just observe for a few days a given option and see that what are the typical trends and how the stock goes in reference to the premium. And then you can just say that, okay, one thing that you have to understand in stock option trading, the premium that you paid starts going down every day. That means that the more the time passes, you're getting close to your expiration date, you start losing your money.
राशिद, this is तैमूर. मुझे ये बता कि डेटा डाउनलोड कहाँ से करना है? ये जो डेटा की बात कर रहा है.
I just showed you. Look at this here.
आप अपनी वीडियो शो कर रहे हैं ना, the series पर.
Okay, so let me just go back. I'm sorry. I did not realize that I was not sharing my screen. Okay, so let me just go back and show you that if you go to Yahoo Finance, simple, here, and you just simply say, put the ticker in there. And once you have these, go to charts. You can just go and add indicators here. Bollinger, RSI, MACD, all these indicators are available for free. Also, I just told you that another favorite of mine is like these called the stock charts, stockcharts.com. That also plots these things. Okay, now where you get the data from, it's very easy. You go to Yahoo and then say historical data, and then just put it, what is the time period for how long you want it, and just simply say download data here. It's going to download an look here, and this is just downloading an Excel file. And once you have this Excel file, you can just play with it. The only things are these: open, high, low, close, adjusted. These are the ones that are data that you're available. You can just plot it, play with it, compute moving averages, whatever you want. Technically, you can just do all kinds of indicators that you want yourself that are done for you. When I started my journey, actually just started like learning how to plot this thing. These are my own plots. I plot these RSI and MFI, MACDs. I also plot this sort of like simple moving averages. This is not quite an alligator, but it gives me some insights from there. And I also plot my candlesticks and with the volume. But on the top,
did you explain this Fibonacci?
I'm sorry, say it again.
Did you explain this Fibonacci?
No, I did not touch the Fibonacci. Yeah, that was not one. Yeah.
Can you go over it real quick?
Yeah. So what you want to do with that? Because I did not use Fibonacci.
If you have not prepared for this topic.
No, I have not. So I have not. So I did not use it. So I mean, I can certainly just try to understand and then explain it sometime offline. So okay, what else is the question?
So one thing I would point out is, since we are over time and about 10-15 participants have probably dropped off, I want to be respectful to all of those people. If everyone agrees, we could probably do a wrap here. Taimur bhai, feel free to jump in if you disagree, but we could probably do a wrap, and we can document the questions, share those with Dr. Rashed, and he can respond to those in written text form, and then we can publish that if that works for everyone.
Ali's the boss.
Great, wonderful. Thank you very much, and have a wonderful rest of the day.